Hey investors! Ever heard whispers about a super ETF that's crushing the market? Well, you're not alone. Recently, there's been a buzz in financial circles about an ETF that's outperforming even the mighty S&P 500. It's got everyone from Wall Street analysts to your next-door neighbor talking. But here's the kicker. This isn't some secret fund only the elite know about. In fact, you've probably heard of it before. So, what's this mystery ETF that's got everyone so excited? Stick around, because in the next few minutes, we're going to dive deep into this investment phenomenon and uncover whether it's really as super as everyone claims. So, what's this super ETF everyone's talking about? Drum roll, please. It's the Nasdaq 100 ETF. Now, before you roll your eyes thinking, oh, that old thing? Let's break it down. The Nasdaq 100 isn't just any index. It's home to some of the biggest tech giants you use every day. We're talking Apple, Microsoft, Amazon, and more. Imagine if the cool kids table in high school became an investment fund. That's basically what the Nasdaq 100 is. It tracks the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. But here's the thing, it's not just a tech fund. Sure, it's tech-heavy, but you've also got companies like Starbucks and Costco in there. It's like a who's who of corporate America, with a strong tech flavor. And that's exactly why it's been turning heads lately. But before we get too excited, let's dig a little deeper into what makes this ETF tick. Now, let's talk numbers. And boy, are these numbers impressive. Picture this. Since 2010, the Nasdaq 100 ETF has skyrocketed by a whopping 1,500%. That's not a typo, folks. 1,500%. In the same time, the MSCI World Index, the one that tracks stocks from 23 developed countries, grew by 439%. Now, 439% is nothing to sneeze at, but compared to 1,500%, it's like comparing a sports car to a rocket ship. But here's where it gets interesting. Up until about 2012, these two were neck and neck, like twin brothers growing at the same rate. Then suddenly, the Nasdaq 100 took off like it had rocket fuel for breakfast. It's been outpacing the MSCI World ever since. Now, I know what you're thinking. Why am I not all in on the Nasdaq 100? It's tempting, right? But remember, in the world of investing, past performance doesn't guarantee future results. It's like assuming the star quarterback in high school will be the next Tom Brady. Sometimes it happens, but often, well, let's just say, life has other plans. So, before we get too starry-eyed over these numbers, let's look at what's really driving this performance, and more importantly, what risks might be hiding behind all this glitz and glamour. Let's peek under the hood of this high-performance ETF. If the Nasdaq 100 were a pizza, it'd be absolutely loaded with tech toppings. We're talking a tech feast here. Picture this. The top 10 companies in this index make up a whopping 50% of its value. That's half the pie in just 10 slices. And guess what? Except for Costco, which is like the pineapple on this tech pizza, all these big slices are tech or tech-adjacent companies. But wait, there's more. When you look at the whole Nasdaq 100 pizza, about 2/3 of it is covered in tech toppings. That's a lot of tech in one bite. Now, some of you might be thinking, great, I love tech. And sure, tech has been the golden child of the stock market lately. But remember, putting all your eggs in one basket or all your toppings on one pizza can be risky. This tech-heavy composition isn't by design, mind you. The Nasdaq 100 didn't set out to be the tech index. It just so happens that tech companies have grown so massive, they've essentially taken over. It's like they came to the party and ended up hosting it. But here's the million-dollar question. What happens when the tech party winds down? That's something we need to consider before we go all in on this tech-loaded index. Now, let's hop into our investing time machine and take a trip back to the year 1900. Imagine you're a savvy investor back then, looking at the hottest sector of the time. No, it wasn't tech, it was transportation. Railways were the tech giants of their day, making up a massive 38% of the market. Everyone thought railways were the future. I mean, what could possibly replace trains, right? Fast forward to today, and transportation makes up a measly 2% of the market. That's right, from 38% to 2%. It's like going from being the captain of the football team to warming the bench. Now, you might be thinking, but tech is different. It's the future. And you're not wrong. Tech is incredibly important. But so were railways back in the day. The point is, markets change, often in ways we can't predict. Think about it this way. If I told you 20 years ago that a company selling books online would become one of the most valuable companies in the world, you might have laughed. Or that a social media platform started in a college dorm would be shaping global politics. The future is full of surprises. This doesn't mean tech is going to crash and burn. But it does mean that putting all your money into one sector, no matter how promising it looks, is risky. Today's tech giants could be tomorrow's railways. Remember, the stock market isn't about picking the winner of today, it's about finding the winners of tomorrow. And those winners might come from sectors we're not even thinking about right now. Maybe it'll be biotech, green energy, or something we haven't even imagined yet. So, while the Nasdaq 100's performance is impressive, history teaches us to be cautious about sector dominance. Because in the world of investing, the only constant is change. Now, let's address the elephant in the room. If you're dead set on riding the tech wave, is the Nasdaq 100 really your best bet? Spoiler alert, maybe not. Let me paint you a picture. Imagine two race cars on a track. One is the Nasdaq 100, and the other is a pure tech ETF, like the S&P 500 Information Technology Sector ETF. Since 2016, these two have been in an intense race. But here's the kicker. The pure tech ETF has been leaving the Nasdaq 100 in the dust. We're talking about a 550% gain for the tech-only ETF versus the Nasdaq 100's impressive, but not quite as stellar performance. It's like the difference between a cheetah and a really fast house cat. Both are quick, but one is clearly quicker. So, what's going on here? Well, remember when we said the Nasdaq 100 isn't purely tech? Those non-tech companies, as successful as they might be, are actually slowing it down in the tech race. It's like having a few regular runners in a team of sprinters. They're still fast, but they're dragging down the average speed. Now, this doesn't mean you should immediately dump your Nasdaq 100 ETF and go all in on tech. Remember, higher returns often come with higher risks. The tech-only ETF is like a roller coaster, thrilling, but with some stomach-churning drops along the way. The takeaway here? If you're investing in the Nasdaq 100 thinking it's the best way to capture tech growth, you might want to think again. It's a great index, don't get me wrong, but it's not a pure tech play. And in the world of investing, knowing exactly what you're buying is half the battle. So before you jump on the Nasdaq 100 bandwagon, make sure it aligns with your investment goals and risk tolerance. All right, folks, it's time to pull back the curtain and look at the hidden risks lurking behind the Nasdaq 100's dazzling performance. It's like that perfect-looking house you're about to buy. Before you sign on the dotted line, you'd better check for termites. First up, concentration risk. Remember how we said the top 10 companies make up about 50% of the index? Well, that's a double-edged sword. When these big players are doing well, it's party time. But if they stumble, they can drag the whole index down with them. It's like having half your eggs not just in one basket, but in the hands of 10 people juggling that basket. Next, let's talk about the tech factor. Sure, tech has been on a tear lately. But what happens when the tech bubble deflates? And trust me, bubbles always deflate eventually. When the majority of your investment is tied to one sector, you're essentially putting all your chips on red at the roulette table. It might pay off big, but it could also wipe you out. There's also the growth versus value factor to consider. The Nasdaq 100 is heavily tilted towards growth stocks. These are the cool kids of the stock market. Exciting, full of potential, but also more volatile. When the market mood shifts and investors start craving the stability of value stocks, the Nasdaq 100 could be left out in the cold. And let's not forget about regulatory risk. Big tech has been in the crosshairs of regulators lately. One big antitrust lawsuit or new piece of legislation could send shockwaves through the entire index. Lastly, there's the simple fact of valuation. After such an incredible run, many companies in the Nasdaq 100 are trading at sky-high valuations. It's like a game of musical chairs. The music's still playing, but when it stops, not everyone will find a seat. Now, don't get me wrong. I'm not saying the Nasdaq 100 is a bad investment. It's just that, like that cool sports car you've been eyeing, it comes with some risks. And in investing, knowing the risks is just as important as chasing the rewards. So before you go all in on the Nasdaq 100, make sure you understand what you're really buying into. Let's zoom out and look at the bigger picture. We've been raving about tech, but there's another sector that's been quietly crushing it in the background. Healthcare. It's like the tortoise in the race against tech's hair. Since 1960, if you had invested $100 in the tech sector, you'd have about $40,000 today. Not bad, right? But hold on to your hats. The same $100 in healthcare would have grown to a whopping $100,000. That's more than double the return of tech. Now, I know what you're thinking, but tech has been on fire lately. And you're right, tech has been the star of the show in recent years. But investing isn't about what's hot right now, it's about long-term performance. It's like choosing between a sprinter and a marathon runner. The sprinter might look impressive in short bursts, but it's the marathon runner who goes the distance. Healthcare's steady performance comes from a simple fact. People always need medical care, regardless of economic conditions. It's recession-resistant. Tech, on the other hand, can be more vulnerable to economic swings and changing consumer preferences. But here's the kicker. The Nasdaq 100, despite its tech-heavy reputation, doesn't ignore healthcare. Companies like Gilead Sciences and Moderna are right there in the mix. It's like the index is hedging its bets, combining the growth potential of tech with the stability of healthcare. The lesson here? Don't get so starry-eyed over tech that you ignore other promising sectors. Diversification isn't just a fancy investing term. It's a strategy that can help your portfolio weather different economic storms. Remember, in the investing world, slow and steady can often win the race. Now, let's bring it all home. We've talked about the Nasdaq 100, tech ETFs, and even healthcare. But what's the best move for long-term investors? Should you go all in on a sector ETF like the Nasdaq 100 or stick with a broad market ETF? Think of it like this. Sector ETFs are like specialty restaurants. They can be amazing when you're craving that specific cuisine. But eat there every day, and you might miss out on a balanced diet. Broad market ETFs, on the other hand, are like a well-stocked buffet. You get a bit of everything, ensuring you don't miss out on any nutritional, or in this case, financial benefits. Broad market ETFs, like those tracking the S&P 500 or total stock market, offer built-in diversification. They're like an all-weather jacket, designed to handle whatever the market throws at them. Sure, they might not give you the thrilling highs of a sector ETF during a boom, but they also shelter you from the crushing lows during a bust. Remember, Today's market darling can be tomorrow's disappointment. By spreading your bets across the entire market, you're essentially saying, I don't know which sector will outperform next, so I'll own them all. It's a humble approach, but often a smart one. That said, there's nothing wrong with spicing up your portfolio with some sector ETFs if you have strong convictions. Just remember to keep it balanced. Think of it as adding some hot sauce to your investment buffet. A little can add flavor, but too much might give you indigestion. So, what's your take on this? Are you team broad market or team sector ETF? Or maybe you're playing for both teams? Share your thoughts in the comments below. And if you found this breakdown helpful, don't forget to hit that like button and subscribe for more no-nonsense investing insights. Your support helps us keep serving up fresh financial food for thought.